There's a very specific kind of silence that happens in a room full of engineers the night before something enormous. Not nervous silence, not excited silence. The kind of silence where people already know how the story ends, and they're just waiting for the calendar to catch up. That silence is happening right now inside a building in Hawthorne, California, and the people sitting in it are about to become generationally wealthy in a way that most of us will only ever read about. My name is Daniel, and what I want to talk about today isn't really about SpaceX. It's about a much quieter, more uncomfortable question that this whole thing forces us to sit with, which is why every single time something like this happens, the wealth lands on the same kind of people, and what it would actually take for someone like you to be a different kind of person this time. Let me start somewhere unexpected. Think about the last time you made a decision that cost you something in the short term because you genuinely believed in where something was going. Not a grand gesture, something small. Maybe you took a lower-paying job because you believed in what the company was building. Maybe you skipped a purchase because you were stacking cash towards something that mattered. Most people do this occasionally. But there's a specific group of people who made that exact kind of decision about a rocket company 15 years ago, and the math on that decision is now so large it barely fits in a sentence. SpaceX is going public. The ticker is SPXC. The valuation is sitting around $1.75 trillion, and somewhere between 13,000 and 18,000 employees are about to see paper wealth become real wealth in a way that most of us have never experienced and genuinely struggle to picture. What I find psychologically interesting about this moment isn't the number, it's the structure of how it happened. Because if you go back and look at why those employees are rich, it isn't because they predicted the future correctly. It's because they agreed to be paid partly in something that felt uncertain, in something that had no guaranteed price tag, and they held it while the rest of the world watched from a safe distance. The senior engineer who joined in 2012 and took stock options instead of a bigger salary wasn't making a confident bet. They were making a patient one. And patience, it turns out, has a return on investment that almost no financial product can touch. It just has a terrible user experience while you're inside it. Here is the thing about SpaceX's business that I think most casual observers misread. People assume this is a rocket company. It's not really. The rockets are the infrastructure. The actual business, the part that generates consistent, scalable, software-grade margins, is Starlink. Over 10 million subscribers across more than 155 countries, around $11 billion in revenue in 2025, with a 60% adjusted margin. What that means in plain terms is that once the satellites are up there, signing up a new customer costs almost nothing relative to what they pay. A cruise ship paying $34,000 a year for internet, an airline paying closer to $300,000. Remote communities that have never had broadband before and have exactly zero alternatives. That's not a subscription business. That's closer to a utility disguised as a tech product, and the pricing power that comes with being someone's only option is genuinely difficult to overstate. And here's the part that makes the competitive moat almost absurd. To challenge Starlink, a competitor wouldn't just need better satellites, they'd need to launch thousands of them, cheaply, repeatedly. And the only company on Earth with the launch economics to do that at scale is SpaceX itself. Some of Starlink's would-be competitors are literally launching their own satellites on SpaceX's rockets. Wrap your head around that for a moment, because it's one of those structural advantages that sounds too convenient to be true, except that it is completely true and has been true for years. Now, I promised you this conversation would go somewhere unexpected, so let me take you there. If you've been paying even casual attention, you've probably seen something online in the last few weeks. Pre-IPO SpaceX shares, tokenized SpaceX funds, some private deal with a surprisingly clean return estimate slipped into your DMs or comment section. I need you to hear me clearly on this. That world is full of landmines. The legitimate secondary market for pre-IPO shares, platforms like Forge Global or EquityZen, requires what the SEC calls accredited investor status, a net worth over $1 million, excluding your primary residence, or an income above $200,000 annually for 2 consecutive years. Those thresholds haven't been updated since 1982, by the way, the year E.T. was in theaters. The bar was drawn in a different economic world, and it's still being used to sort who gets access to private wealth creation. If you're not past that threshold, this route is legally closed, and if someone is offering it to you anyway through some back channel, they are not offering you opportunity. They are offering you risk wrapped in excitement. Which brings me to where the real conversation lives, because this IPO has done something unusual and worth paying attention to. SpaceX has reserved roughly 30% of the offering for retail investors, meaning regular people with normal brokerage accounts at places like Fidelity, Schwab, Robinhood, and SoFi can actually submit what's called an indication of interest to request shares at the IPO price of $135 before the stock begins trading. That's a larger retail carve-out than almost any comparable offering in recent memory. The catch, and there always is one, is that demand will be so intense, the allocation each individual gets will likely be small, sometimes just a handful of shares, sometimes nothing at all. So you can try, and it's genuinely worth trying if you want any piece of this, but you should not structure your financial decisions around receiving a meaningful allocation, because the arithmetic simply doesn't support that optimism. If this kind of thinking about money connects with something you've been looking for, now would be a great time to subscribe. This channel exists for exactly these conversations, the ones about how money actually moves, not how we wish it did. After the IPO begins trading, any brokerage account in the world can simply buy the stock on the open market. No gatekeeping, no income tests, no lottery. The complication here is that mega IPOs tend to open at prices driven by the most enthusiastic buyers alive, and enthusiasm is not a reliable valuation tool. History is consistent enough in this that it's worth taking seriously. Many large IPOs give back 20 to 40% in the months after the initial frenzy, particularly around lockup expirations, when insiders who've been holding for years are finally legally free to sell. SpaceX's lockup rolls out in stages through the end of this year, with a significant expiration somewhere around December. A patient person watches that date the same way someone waits for a flight delay to clear before racing to the gate. The fourth path into this, and the one almost nobody is actually discussing, is the most quietly intelligent. Alphabet, Google's parent company, owns somewhere around 5 to 6% of SpaceX, worth roughly $100 billion. If you buy Alphabet stock through any standard brokerage account with whatever you have available, you are indirectly buying a slice of SpaceX at no speculative premium, wrapped inside one of the most profitable businesses that has ever existed. It's not glamorous, it doesn't make for a great story at a dinner party, but there's a reason the unsexy moves tend to outperform the exciting ones over time, and that reason is that unsexy moves don't attract the kind of emotional premium that eventually corrects painfully back to earth. I also want to say something about the valuation, honestly, because I think it matters. At $1.75 trillion, SpaceX is being priced at over 100 times its 2025 revenue. The consolidated company posted a net loss approaching $5 billion last year, after absorbing the costs of folding in an AI company. Independent analysts at places like Morningstar have put fair value closer to $780 billion, less than half the IPO price. That doesn't mean SpaceX is a bad company. It's probably one of the most extraordinary companies ever built. But extraordinary company and extraordinarily priced stock are not synonyms, and confusing them is the single most expensive mistake a retail investor makes around events like this one. Here's what I'd actually encourage you to think about. If you want exposure to this company, decide on an amount you could genuinely afford to lose entirely without it affecting your actual life. Then split it across time. A piece now, a piece after the first earnings report in the fall, a piece around that December lockup.
Not because this perfectly times the market, nothing does, but because it removes the psychological weight of needing to be right about a single day. The people who will get hurt most by this IPO are not the skeptics sitting it out. They're the people who love the company so deeply that they stop seeing price as a variable. Loving a company is an emotion. Investing in it well is a completely separate skill. Thousands of people are about to become wealthy because of decisions they made years ago in quiet rooms, without applause, without certainty. That part of the story is already written. The part that isn't written yet is whether the people watching from the outside learn anything different this time, or just move to the next story on their feed. I'm not asking you to buy anything. I'm asking you to think about what kind of investor you actually want to be, and then to behave accordingly, which is harder than it sounds and rarer than it should be. If this kind of thinking about money landed in a way that felt useful, subscribe, because the next wealth event that comes around, I want you walking in already knowing the language. And tell me in the comments, when you look at something like this,